Hi, Assalamualaikum. So today our group will be presenting about capital structure for FIN537. But before that, we waiting to our lecturer, Madam Shuhada, and for those who are watching this video. And before we go further, here we show you the content that we will cover on this video. And before we jump further, I will introduce you our group members. Starting from me, I am Adham Mirza, followed by Zarul Azril, Maisara, Hamad Haziq, and Alia Amira. And for my part, I will explain about the definition and component of capital structure, as well as the significance of capital structure for the company. And for the definition, capital structure is the combination of debt and equity that the company used to finance its overall operation and expansions. And the company ownership shares and its claims to future profit and cash flow are the sources of equity capital. The items include bond and loans, while for equity, items include common stock, preferred stock, and retained earning. And how capital in a company is managed can differ based on what kind of capital it is. The two most important kind of capital are debt capital and equity capital. Business need to show the shareholders and investor on how they can have the solid debt to equity or debt to capital ratio to encourage the company the support from financially or otherwise. And the next one, we talk about the component of capital structure. So the component of capital structure is divided by two, which is the shareholders fund and forward funds. For the shareholders fund, we have the equity capital. It is the new shares that are liable to get the dividends in proportion to the profit earned by the company. And the second one, we have the preference capital. It is to enjoy a fixed rate of dividend along with the preferential right of receiving the return on the company of the capital in the case of the company liquidations. And the third one, we have the retained earning. It is to utilize the fund available if it is renewable retained earning accumulated by the keeping aside some part of the pro-business growth and expansions. And for the borrowed fund, we have the debentures debt. It is the instrument which the company and the government issued to the public. And the second one, we have the term loans. It's the fund acquired by the company on the bank as it is floating fixed rate of interest. And the last one, we have the public deposit. The management invite public through the advertisement to create the deposit in the company. So capital structure is really important for the companies, and there's a lot of examples how the capital structure plays their roles. The first one is to boost the market value of the securities and shares that are owned. The second one is to ensure that the available funds are used effectively. And the third one is the flexibility of increasing or decreasing their debt capital. And the last one is to create increasing and maximizing their profit in the form of higher returns.
The first factor is business risk. The nature and volatility of a company business activities impact is capital structure. For instance, companies in stable industry may prefer more debt to leverage their operation, while those in cyclical industry may option for less debt to avoid financial distress during downturns. An example will be a utility company which typically carries more debt due to its stable cash flow. And the next factor is tax consideration. Tax policies affect the attractiveness of debt financing due to interest tax shields. Companies in high tax jurisdiction may favor debt to benefit from tax deduction on interest payments. An example is how companies in the United States often use debt financing to leverage tax benefits. And the last factor is cost of capital. The cost of debt and equity financing influence capital structure decision. If debt is cheaper than equity, a company may use more debt to reduce its overall cost of capital. Conversely, if equity is less expensive, the company may prefer equity financing. For instance, during period of low interest rates, companies may issue more debt to take advantage of favorable borrowing conditions. That's all from me.
When it comes to making decisions about its capital structure, AirAsia takes into account various considerations and objectives. Let's dive into it. Okay. One of the primary consideration for AirAsia is maintaining a balance between debt and equity financing. They carefully assess the amount of debt they can take on without compromising their financial stability. By leveraging debt, they can fund their operation and expansion plans while minimizing the dilution of ownership. Another key objective for AirAsia is optimizing their cost of capital. They strive to strike a balance between the cost of debt and the cost of equity. This helps them minimize their overall cost of funding and maximize shareholder value. AirAsia also considers the market conditions and investor sentiment while making capital structure decisions. They analyze factors such as interest rates, market volatility, and investor appetite for their equity offerings. This allows them to make informed decisions about the timing and size of their capital raising activities. Furthermore, AirAsia aims to maintain a strong credit rating to access favorable financing terms. They prioritize maintaining a healthy financial position, which includes managing their debt levels and demonstrating consistent profitability. This helps them negotiate better interest rate and terms with lender. Lastly, AirAsia's capital structure decisions align with their long-term growth strategy. They consider the funding requirements for expanding their fleet, opening new routes, and investing in technology and infrastructure. By carefully planning their capital structure, they ensure they have the financial resources to support their growth objectives. Overall, AirAsia's decision-making process regarding its capital structure involves balanced debt and equity, optimizing the cost of capital, considering market condition, maintaining a strong credit rating, and aligning with their growth strategy. I hope this sheds some light on AirAsia approach to capital structure decision. Thank you.
Hi, Assalamualaikum. My name is Amar Hazib bin Rashdan, and for my part, I will talk about theories of capital structure. So basically, there are three theories of capital structure that we learn in the syllabus, but in this video, I will explain about two theories, which are packet order theory and also trade-off theory. Now, without further delay, I will begin explain the packet order theory. The packet order theory was proposed by Stewart C. Myers and also Nicholas Maljouf in 1984. This theory suggests that companies follow a hierarchical approach to financing, preferring internal funds first, then debt, and finally use their own equity. Basically, there are many advantages of packet order theory, and one of the advantages is simple and intuitive framework, which is the theory provides a straightforward framework for understanding how companies make financing decisions based on their preference for internal funds, debt, and also equity. And for the next theory is the trade-off theory. So, to put it simple, it is a concept in finance that examines the balance between benefits and drawbacks of using debts versus equity financing. It explores how companies decide on the right mix of debt and also equity to fund their operation while considering factors like risk, cost, and also financial flexibility. Just like packet order theory, the trade-off theory also have several advantages, and one of the advantages is risk management, which is by weighing the benefits and cost of debt and equity financing, companies can tailor their capital structure to manage financial risk effectively. For instance, they may choose more debt during periods of low interest rate but switch to equity when facing economic uncertainty. To understand more about trade-off theory, I will provide one example or illustration so that we can fully understand about this theory. So ABC Industries want to grow its production. They can get money in two ways. The first one is borrowing, which is debt, and the second one is selling parts of the company, which is equity. So what ABC company should do? ABC company should look at both options using the trade-off theory. They want a mix of debt and equity that balance risk and cost. In this way, they can grow while keeping their finances healthy. So that's all about.
Next, I will present to you about the agency problems. So today, we explore a vital facet of corporate finance, capital structure decisions. While pivotal for a company's expansions and resilience, these decisions frequently obscure underlying agency issues capable of eroding shareholder value. So, let's examine various potential agency problems stemming from capital structure decisions supported by real-world instances to elucidate their consequences. There are two agency problems that I will explain. The first one is risk shifting and asset substitution. For the risk shifting, it is aggressively leveraging debt for rapid growth, prioritizing short-term gains over sustainable strategies, risking significant shareholder losses, as seen in the 2008 financial crisis. Imagine a company that chooses to aggressively leverage debt to fuel rapid expansion. In this scenario, motivated by short-term gains, management may allocate these borrowed funds into high-risk ventures to artificially boost performance metrics or their own bonus. However, these ventures fail, shareholders could suffer significant losses. An illustrative example of such behavior unfolded during the 2008 financial crisis, where numerous financial institutions pursued risky mortgage-backed securities, prioritizing immediate profits over sustainable growth. This short-sighted approach resulted in dire consequences for both institutions and the broader economy. The asset substitution, it occurs when managers prioritize project benefiting equity holders over debt holders, leading to potential financial misrepresentation, as exemplified by the Iran scandal, where executives manipulated financial records to conceal escalating debt levels and project failures. Through the deception, they misled investors, triggering a catastrophic collapse that resulted in substantial losses for both shareholders and creditors. For the next slide, I will present about the cost of equity. As for today, we set forth on an exploration to uncover concealed expenses associated with equity resulting from agency dilemmas in capital structure determinations. Despite the vital role of equity financing in fostering corporate expansions, the existence of agency disputes can escalate the expenses of equity, putting shareholder returns at risk. Let's delve into this occurrence using real-world illustration to eliminate its ramifications. I provide to you two costs of equity that I will explain: the risk of financial distress and market perceptions and reputation. Firstly, the risk of financial distress. Agency conflicts in capital structure decision can increase the risk of financial distress, as demonstrated by Lehman Brothers during the 2008 financial crisis. Equity holders bear significant losses due to heightened bankruptcy threat and value erosion as the company faces imminent collapse. Next, the market perception and reputation. Agency conflicts can damage market perception and reputation, leading to increased cost of equity, as illustrated by the Cambridge Analytica scandal with Facebook. Breaches in data privacy and governance provoke investor backlash and regulatory scrutiny, elevating the risk premium sought by cautious investors. As trust eroded, Facebook experienced an uptick in its cost of equity, indicative of the increased risk premium sought by cautious investors wary of potential regulatory investigation and harm to the company's reputation. The damaged reputation stemming from decisions influenced by agency conflicts can worsen the cost of equity by dissuading investors and hindering the company's capacity to secure capital.
And the next one is signaling hypothesis. So a business may decide to spend a lot of money on the product advertising, and not because it is the most economical way to get the information out of the potential customer, investor or the distributors, but because it is to show the investor or the stakeholder that the company believes strongly on the product that they sell. So what is the signaling hypothesis? It is the theory that the company use their financial decisions to send a signal to investor in order to shake up the asymmetries, so that the company that increase their dividend send a positive signal to the investor and analysts that the company can maintain growth and profitability into the futures. As a way to distribute profit or the shareholder, dividend increase can attract the new investor who seek income in addition to capital gain of their portfolio. So as you can see on the picture above, this is one of the company with the highest dividend yield in Malaysia, which is Malayan Banking Berhad, which forward dividend yield of 9.64%. So the majority of its profit activities are in consumer, corporate, investment, transaction retail and business banking for mostly small and mid-sized enterprise. So as you can see on the data above, it is always increasement their dividends from 2016 until 2017 until 2020. So I think it's a really good example for the company in Malaysia to be a role model for other companies. And in conclusion, by understanding the importance of capital structure, it may improve the company's stability and financial performance by increasing the market price of stock and securities owned. And it's also ensuring that the available funds are used effectively, also preventing over and under capitalization, increasing the company's profit in form of higher return to the stakeholder, and help maximize shareholders' capital while minimizing the overall cost of the capital. And that's all, progress. Thanks for your time.